Greetings from 3Edge Asset Management, and welcome to the 3Edge Week in Review for the week of January 11th. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge, and I'm pleased to be joined here once again by Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. This week, along with a brief update on the global capital markets, Steve and I will be taking a closer look at various measures of investment risk management and point out why here at 3Edge we focus on managing a particular measure of portfolio risk known as maximum drawdown. But before we get to that, let's take a look at where we are in terms of the global capital markets here in the middle of January 2021. Global equities in the first 2 weeks of January did advance based somewhat on the incoming Biden administration's plans for fiscal spending, which were helped out by the surprise victories by two Democrat Senate candidates in the Georgia runoff election. And thus far in January, emerging market and Japanese equities have outpaced U.S. stocks. However, over the last couple of days, global equities hit a bit of a wall as investors seem to become concerned as to whether President-elect Biden would be able to get his incoming administration's fiscal spending package approved by Congress. Perhaps yet another example of how oftentimes investors buy the rumor and then sell the news. So Steve, I want to bring you in here to talk about the markets because one of the changes that we have seen early in 2021 is that interest rates are actually rising. The 10-year U.S. Treasury yield, we know that it broke above that 1% level and trading now about the 1.13% yield, which is higher than it's been since March of last year. And then even the 30-year bond has moved higher. At one point, it was up around 1.88%. And that would have been its highest level since February of last year. And then the other factor now then is that the increase in yields in the longer dated notes and bonds, combined with the Fed holding the short end artificially low, means that we have the steepest yield curve since 2017. So I'm very curious to get your take on this recent uptick. Is this for real? Is it a blip? What are your thoughts?
Well, Fritz, I'd have to say that the fact that the long-term interest rates are going up right now is very consistent with the prospect of reflation. What I mean by that is now that Democrats control both the administration and both houses of Congress, there is increased likelihood or prospect of much more fiscal spending, whether it be for infrastructure or for economic rescue, recovery, to address inequality, for a number of reasons. And the numbers being talked about are now another 2 trillion and then more down the road. So these are very, very big plans. And this could help boost economic growth in the short term, at least, if not the long term. But it could also bring with it more debt because the government doesn't have this money, it needs to borrow the money, and the possibility of higher inflation. So that's all consistent with rising yields. And as you mentioned, while the Fed wants to keep interest rates low, they're primarily controlling the short end of the curve, where most of the money that they print is being used to buy Treasury bills, which are 3-month in duration. And the long end, 10 years, 20 years, 30 years, is mostly set by the market. It remains to be seen if the Federal Reserve Board down the road will decide to take more of its printed money and use it to buy longer term bonds.
Excellent. That very good clarity on that topic. So now let's move on to our topic for today, which is risk management and the different measures of risk management in the investment industry. And after a year like 2020, when equity markets have strong performance, as investors, it's natural that, we want to talk about performance. And, we were pleased with our investment performance across our 3Edge strategies in 2020. However, here at 3Edge, our investment objective has always been to generate attractive risk-adjusted investment returns. Since we believe that to be a successful long-term investor, it's important to not only focus on generating returns, it's also important to understand the amount of risk that one takes to generate those returns. And when discussing risk management, we find that oftentimes the focus is exclusively on volatility. And there are a variety of risk measures that are more focused on volatility, and they include the Sharpe ratio, for example, which was developed by William Sharpe, who is a Nobel Prize winner in economics for his work on the capital asset pricing model. And the Sharpe ratio seeks to describe how much excess return a portfolio manager can generate for each additional unit of risk measured by volatility that they take. And so the greater portfolio Sharpe ratio, the better the risk-adjusted return is for that portfolio. Another measure of risk is standard deviation, which we talk about often. And this is measuring the degree of variation of returns around the average or the mean portfolio return. A more volatile investment portfolio carries a higher standard deviation, which indicates wider swings, either up or down in a portfolio relative to the portfolio's expected rate of return. And we do seek to manage volatility with our strategies, right? I mean, we refer to this as seeking to smooth the ride for our clients. And the objective is to manage the often unsettling swings in the market, which may cause investors sleepless nights and may even cause them to make investment decisions that are not in their long-term best interest. And lastly, there's beta, which is used to help investors understand whether a portfolio moves in the same direction as the rest of the market. And we measure beta as well. We measure the beta of the three-hedge strategies relative to the S&P 500. And measuring beta is important for us because one of the advantages of our strategies is we seek to generate returns while maintaining a low beta to the S&P 500. So Sharpe ratio, standard deviation, and beta, all common measures of risk, and they're all useful. I mean, but importantly, the three-hedge strategies score well across those measures of risk, those measures of volatility. However, a foundational belief at three-hedge is that it's incomplete to only measure risk as volatility, which brings us to maximum drawdown, which measures the worst historic decline of an investment portfolio before that portfolio returns back to break even or back to where it started prior to the decline. And maximum drawdown shows percentage terms how much money an investment portfolio would have lost before returning to break even. So Steve, you are the perfect person to address maximum drawdown because I know that all your years of studying the markets and all your years of portfolio management, you have always focused on not only using Sharpe ratio, standard deviation, and beta, among others, but I know that you have always been laser focused on managing maximum drawdown as well. So perhaps I'm going to turn it over to you and let you explain why it's so important to manage a portfolio's potential maximum drawdown when considering investment risk.
Well, Fritz, full disclosure, for years, it's been upsetting to me to see how Wall Street hides behind volatility measures of risk to give misleading advice to its clients. The idea that the stock market is not so risky and people should always have, whether it's all or a big portion of their money in stocks and just ride it out. And that's always bothered me because by using volatility, it gives the false impression that stocks are much less risky than they are. And if you go over time, if you held a stock portfolio, and we stress test all our portfolios going back many decades, you would have found that worst case scenario was during the past, holding an all equity portfolio, you would have lost 83% of your wealth before things started to rebound. And that's just too much for people to take without getting very fearful, getting very upset, and maybe selling right at the bottom. Now, people could dismiss that, well, that just happened once in a blue moon. Well, there were 4 times in the last few decades where stocks went down more than 40%. And I don't think any of our clients, or certainly none of us, would want to sit there and just watch stocks go down 40% and be helpless. And also, if stocks, let's say, they go down 50%, you have to make 100% return just to get back to where you started. And that's really not so helpful. So what I believe is that the truth is that stock market investing is more risky than conventional management would suggest, than Wall Street would suggest. And what we do is we take as scientific an approach as possible to look at the valuation measures, to look at the economic factors, to look at behavioral measures, and to be able to make a judgment and an assessment using our research and our models. When is it more likely than not that stocks are vulnerable to a big drawdown? And let's not just sit there and take it. Let's get our clients and ourselves out of the way to the extent possible. And having said that, we don't always want to be out of stocks. More often than not, stocks are the best performers in the market. So we can take advantage and participate most of the time when stocks do well But if we can do that and at the same time sidestep some of the major downturns, like what happened last year in February and March, then not only do we end up with better compound annual returns, but we have a client base, and ourselves, we're clients too, of not having to be put through the ringer and having to make tough decisions when the market's down 20%, 25%, 30%. Is that enough pain? Is it now time to sell? And statistics show that most people sell at the worst time. They hang on. And the majority of selling, just like it happened in March, happens right near the bottom. So we do everything we can to try to avoid that.
Excellent. So that is a very, very helpful and informative example of how we think about maximum drawdown and just how important it is to manage that maximum drawdown in client portfolios. So very much hope that this discussion about investment risk was helpful and informative, and that you learned why at 3Edge we're so focused on managing maximum drawdown. So that will do it for Steve and me. We will be back next week with another edition of our 3Edge Week in Review. In the meantime, on behalf of everyone at 3Edge, we urge everyone to exercise caution as we may be in for a few more difficult months in terms of the coronavirus. So stay strong and keep the faith, and thanks for listening.